Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld, and we're counting down to the last solar eclipse until 2044.
I missed the 2017 one, so this time I'm prepared with my $1 glasses.
I'm just grateful that our show is not during the solar eclipse. I don't think many people will be watching TV. So while we still have you, let's get to the biggest stories right now in the more than $12 trillion global ETF industry. And we start with Bitcoin passing the $72,000 mark, despite the moderation in appetite from ETF investors.
And we'll look at the Michael Keaton indicator tied to the Nikkei index, which has some people hoping for another appearance for him as Batman.
I am interested in the ETF connection there, but we're also going to discuss an active ETF which invests in closed-end funds. Leah Jordan of Saba Capital joins in just a moment, but as always, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you very much. And so the flows in the past week really are a microcosm of the whole year. And that is that investors really like stocks and Bitcoin. That seems to be the risk-on mentality of all investors. Look at the top there, VU. VU, by the way, $26 billion this year for VU is extraordinary. That's $100 billion a year pace. That would blow away the record if it holds. And then we've got SPY in there, and then IBIT, and then you've got a little lower COWZ. That's a cash cow ETF. SPLG is another S&P 500. So it's really showing a lot of people buying U.S. stocks in particular, large caps in particular, and adding a little Bitcoin. Let's look at the outflows. And if you look at the outflows, you're going to see IVV at the top. Now, I think iShares made some moves in its model portfolio, which is accounting for that outflow. And a lot of that money went into tech and growth, even more bullish than IVV. So I would call that actually positive sentiment. GBTC continues to bleed. That's part of the Bitcoin story. And then you got TLT with outflows there, HYG. You know, again, some spattering of outflows, but 22 billion net inflows. Let's look at the Bitcoin ETFs. We'll basically look at the past week, because every time it seems like they're dying down and maybe we're going to go to outflows, bam, they get like another wind, right? So if we look at the past week, IBIT with 800 million, that's, again, really good because it now 59 straight days of inflows. And this is with some price volatility. The price obviously went up recently, but in the volatile days, IBIT and FBTC still eking out inflows, even if they weren't as big as they used to be. And then look at the whole complex. I added in here Bitcoin futures ETFs and leveraged, just all flows, right? Even some of these guys, which we'll call the middle class. In particular, BTCW, it's the smallest Bitcoin ETF. It's still taking in 23 million, 63 million. These are pretty big numbers for a new launch. They just look small compared to these other numbers. So just when we think, you know, maybe it's over, these Bitcoin ETFs have like another surge in them.
Yeah, you have to keep counting the waves here, and we're going to do that now with Todd Son. He is ETF strategist over at Strategas Asset Management. And Todd, great to have you on set with us. I'm curious how you're thinking about what we're seeing in the flows relative to the price action, because Bitcoin, it's hovering near its all-time high. It hasn't exactly broken out from that, and you do have flows moderating at the same time. What are you making of that dynamic?
The spot Bitcoin ETFs are the real deal, right? So when you look at the year-to-date numbers, and they've only been around for almost 3 months now, I believe 8 of the 10 now of the spot products are in the top decile of inflows, right? That's really impressive for a brand new asset class. And when you break it down by dollar volume traded, the majority of them are also in that top decile. So it's not just the iShares and Fidelity and Grayscale products that are being traded. It's the other ones that Eric was just talking about, too, that are picking up steam. You rarely get a new asset class for investors, advisors, whoever, to start playing in the ETF space. And so this is a can't-miss opportunity for everyone out there.
If it's a can't-miss opportunity, shouldn't momentum ETFs or momentum strategies therefore include Bitcoin or Bitcoin ETFs?
That might be a new product idea that you just mentioned there, Scarlett. A momentum equity plus crypto type assets. Because listen, we know about the white space, the whiteboard of ETFs, right? We've got passive pretty saturated, but now you're seeing more quantitative type products come to market that offer some sort of solution. So maybe that's the next idea. I kind of like that myself.
Yeah, Scarlett, I think they're going to throw a lot of spaghetti at the wall, right? These kind of flows are going to attract all kinds of innovation and products. We saw 2X Spot just launched last week. It's going to get wild. I think another thing that's interesting to me is that iShares updated their prospectus to include a bunch of more names of authorized participants. These are the people who make the markets and do the creations and redemptions. Those names that were added were Goldman, Citadel, ABN AMRO, Citigroup, and some others. These are some pretty big banks, kind of conservative. Banks aren't even allowed to touch crypto, but they're allowed to be in this document. Is the shame going away? Because I think some of these firms were a little bit like, I don't know, but the success has kind of made it like, okay, now there's cover. And BlackRock's in it. There's all these billions. We're good having our name in there.
To your credit, the floodgates opened when BlackRock filed for that initial offering, however many, a year or so ago, whenever that was. And now
it was in June, actually. I'll never forget. But go on.
So you're now seeing how successful the products are. I'm curious to see what it looks like on their first major correction from here. What do the flows look like? But if you are a market maker, authorized participant, you have to be involved in the space. It's just too big of an area to miss. Going forward. And so I think the shame factor is going away. It's becoming more widely accepted.
So the shame factor, that is definitely something you're coining right now, the shame factor.
Oh, yeah. I know it well.
Okay, so moving on from the shame factor and Bitcoin, Todd actually brought a prop, which I think is pretty funny. So we're talking about Boomer Candy, which is another Eric Balchunas original. I don't think the resolution is going to be so intense as you can see that you have, income, et cetera, written on those candies. So let's talk about that because it's interesting. You take a look at the likes of JEPI, you take a look at JEPQ, for example, those JP Morgan equity funds that have been so popular. The flows have slowed down a little, but still taking in multi-billion dollars worth of inflows, which is interesting because the broader market has been so rewarding for investors. You don't necessarily need income right now, and yet there's still this appetite for it.
So I just got a text message from a friend of mine who was going to be purchasing a house, and he said, should I sell out of my VTI for an income-producing product? And he's on the younger side, let's put it that way. So you take that and then you translate it into a much older demographic in America, and they love these products. They want the protection from the downside, or they just want that monthly income check. They love it. They were willing to give up the 50% QQQ return for 25% instead. I really think this comes down to demographics in America, that you have such an older generation with a lot of wealth that doesn't want to go through a 2020, 2008 type scenario again, just in case. And so the demand's always going to be there. Maybe you need another 2022 type environment to see JEPI lead inflows again. But demand will always be there because ETFs are a solution-oriented vehicle, and that's what they're providing.
Right. It's all about capital preservation for that particular demographic. For the younger demographic that wants capital appreciation and big, juicy returns, and they want growth, but they're kind of weary of doubling down or tripling down on tech at this point. What are their options within equities?
So I will say we at Strategas just launched our third ETF. It is a tactical ETF. That is supposed to hold a high active share concentrated portfolio of 25 to 50 equities. And I'd say the proposition is when markets deteriorate, the new fund will rotate into more defensive type products, right? So that's what we're offering there, that you're going to still have that active management, high active share, but with the downside buffer. Not quite as systematic as some of the buffered products out there, but I do think it's something that is interesting, and we're looking to get our sea legs going forward with that.
And I'm looking at this, and I'm reading your notes, and I see a trend here. This ETF, which is Momentum, has a lot of oil and gas, banks, mining, pharma. I don't see a ton of tech or software. You think that's overbought? You're moving into these other areas, and I noticed that, as we say in the flows, but the flows show investors can't get enough of that stuff.
Everyone is all in on tech, and it's been the right call, totally. But there is some fatigue underneath the surface, and so I'm just a little bit concerned for a speed bump in the second quarter for technology stocks. And then the beneficiary of that, we consider where rates are going. You consider maybe another whiff of inflation. That should benefit some real assets like energy and material type stocks.
Okay, let's talk about this Batman indicator thing, which I love, because I actually still think the Michael Keaton Batman is the best one. People on my team think that's crazy, but that was 1988, I think, and that was the last time Japan was at an all-time high. It hits an all-time high this year. Michael Keaton is now back in Batman. Is that correlation or causation?
I would love to say correlation, but we both know that it's not. And also Beetlejuice, don't forget that too. So listen, I think if you're looking for a diversifier away from the tech-heavy U.S. and you want international exposure, Japan is the place to be. If I'm remembering from one chart, it's this one, this Japan Michael Keaton idea. But Japan is very heavy industrial, is very heavy consumer discretionary, autos that are not necessarily all in on EV, like a Toyota. And so we want to pay attention to that. That's a great space to say, if I'm worried about having too much software and semiconductor exposure, that's where you go internationally. We love the region, and we think there's more to go here. And you think about it, Japan, Bitcoin, gold, US, everything's at a new all-time high here, which may get you a little bit worried. But when you look at the strength internally from Japan, we think that's a real sustainable bull market.
I think that is a wonderful place to leave this conversation. Todd, really enjoyed this. Great to see you again. That, of course, is Todd Son of Strategas Asset Management. Now, coming up, investors dismissed single stock ETFs when they launched, but 3 years later, they have now found their footing and then some. We'll discuss next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with a gold ETF in China. This actually tracks gold-related companies. And you're taking a look actually at its premium to its net asset value, or at least I believe we should be. But anyway, gold has been on an absolute tear, of course, over the past several months. It's been hitting all-time high after all-time high. When it comes to this ETF, actually trading was halted at one point, which really tells you just how much this frenzy has engulfed the entire world. So that, of course, is physical gold. Let's talk about digital gold, because that also has been on a tear. But actually, if you take a look at ARK's Bitcoin ETF, it did notch its biggest outflow ever last week, $80 million coming out in a single day. But as we were talking about, of course, in the prior block, just the consistency of inflows has been pretty amazing to watch. So that's the ARK Bitcoin ETF. Let's also talk about single stock ETFs. I remember when these launched, there were a lot of people asking the question, why do these need to exist? And you can sort of see that in 2021, 2022 figures, but assets have absolutely exploded, now over $4 billion, and a lot of that growth coming in the past year or so, Scarlett.
All right, so let's talk more about this with, of course, our very own Eric Balchunas. Eric, what was the use case for those single stock ETFs when they launched 3 years ago versus today?
Fun. No. Fun is a big part of it. Look, there's a lot of gambling that happens. I mean, the whole options market, you could argue that's a lot of gambling. So these things just make it easy. They package up what would otherwise be a swap contract with an investment bank. A lot of people can't do that. So these come out and say, oh, look, we'll give you 2 times NVIDIA or 2 times inverse Tesla for one day, just like the leverage ETFs. And I think there is definitely a gambling aspect. I call it package adrenaline. People have a boring 401k, and they're like, oh, let that grow for 30 years, but I want to have some fun in the meantime, make me feel something, and I think these do. I mean, they have a lot of volatility. A lot of them are 10, 20 times more volatile than the S&P. And, well, the one that struck my attention was 2X NVIDIA, traded $2 billion in one day, and now has over $2 billion in assets. And again, as you said, these are literally an oxymoron. Single stock ETF is a contradiction in terms, but add a little leverage, people are going to be attracted to them.
Well, to your point, I think that fun is sort of an investing strategy that can't be ignored. You take a look at what's going on with meme coins, but I digress. You bring up NVIDIA, and I'm wondering the fact that you have so many single stock stories, the fact that you have some of these breakout stars in the single stock wrapper. I have to imagine that's helping fuel the interest here. Yeah, 2 things really correlate with the assets and flows here. One is volume on the stock itself. So if you look at the most traded stocks, every day, NVIDIA is #1 by about 2-fold. Tesla's #2. Tesla used to be #1. NVIDIA is now like the top dog. Sign of the times.
And those 2 stocks make up like 80% of all the assets in these single stock ETFs. So volume's 1. And #2, you need returns. The best performing ETF this year is 2X NVIDIA, up 180%. That's a lot for, 3 months? And then 2X Meta is even up 100%. And then negative 2X Tesla's up about 100%. So, these are the kind of returns that are definitely going to attract the crowd that wants that sort of adrenaline. Now, there is maybe a legitimate reason. Say Tesla has earnings coming up, and you own Tesla in your portfolio, you want to hedge quickly. Yeah. It might be easier just to click buy a negative 2X Tesla to completely hedge. So I'm going to say there's no serious uses, but I largely think it's retail trading.
And it's simple to use, as you mentioned. All right, Eric Balchunas, these get a red light in the Bloomberg traffic light system, right?
Yeah.
Okay.
Yeah, hard red.
Hard red. All right, still ahead. We're going to drill down into closed-end funds with Leah Jordan of Saba Capital next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric.
Katie, we have Saba today. This is an interesting ETF. This is an ETF, CEFS. This is a ticker. Obviously, if you're a closed-end fund person, you already know what this is. It's the closed-end funds ETF. Closed-end funds, if you don't know, are a type of mutual fund in a way, but only a certain amount of shares are issued. Whereas ETFs, shares can be created and destroyed. So if you have a certain amount of shares, they're going to trade, the price is going to deviate from the NAV. So you have large discounts and premiums in these. And for most investors, they don't want that. But for traders and active investors, this is an interesting place to fish because there's definitely money to be made. You look at the fee here, it's pretty expensive, 2.5%, but that includes the underlying expense ratios of the closed-end funds. So it's a lot smaller than it looks. It's an active fund, so again, they're trying to pick closed-end funds where the discount can narrow and make some money. Let's look at the holdings of this thing, and we'll see what some of the closed-end funds that are in there. Some yield people looking for yield like closed-end funds. Some of these yields can be really high. That's where people, retail may know this. But you can see here, some from BlackRock, Nuveen, all the big asset managers tend to have closed-end funds. They're small relative to mutual funds and ETFs. So this is the holdings right now. Let's look at the performance of this fund. I went over the last year, just compared to the S&P. There really isn't too much competition out there for this thing. So S&P's up a little bit, but look at the yield. So this thing returned 13% price, but the yield, again, gave you a big chunk of that return. So this has a high income. I think it's yielding about 8% right now, whereas the S&P you get very little. So that's definitely going to be an attraction here. So again, unique fund, Katie, for people who don't want to go through the work of combing through closed-end funds.
Eric, thank you. And joining us now to talk about this ETF, we have Leah Jordan. She is a product specialist over at Saba Capital Management. Let's talk a little bit more about the performance, because you compare, of course, CEFS. I'm going to call it CEFS. I don't know if you pronounce it that way, but you compare that to PCEF, which is an Invesco fund, which sort of invests in the broad universe. And you take a look over 5 years or so, and we're talking about healthy outperformance there for your fund. And something I'm wondering, when I take a look at this degree of outperformance, CEF's up, what, 65% on a total return basis versus about 25% for the broader industry. How much of that is coming from mean reversion in these closed-end funds trading at discounts versus these funds that you're investing in are subject to activist campaigns?
Sure. So thank you all for having me. And yes, as Eric pointed out, a lot of it is coming from yield. So you have a healthy yield on this. And closed-end funds can invest in anything under the sun. If you want exposure to equities, to munis, to high yield, even some cases private assets. And so we focus on things that have a yield component to it. And it has an over 8% yield, but also the capital appreciation piece. And that's really where we pride ourselves. Eric kind of pointed out that this is an actively managed fund. What does that mean? The debate has gone on for years, active versus passive. Where can active add money? We're looking to screen closed-end funds for not only the discount, but the yield, the volatility of that discount, what is the underlying volatility, and then also collapse that discount. And in some cases, that will happen just through trading. And we've seen markets go up, markets go down over the last 7 years. But when that doesn't happen, Saba has a repeated track record of being able to do that by force, whether it's through tenders. And I can see Eric laughing because it sounds so forceful. And in some cases it is, but at other times, you say activism, and Saba's won awards for activism. Many times it's just engaging managers and talking about, how they can manage these products to not trade at a discount. You saw some of the names on that list, Eric. It's Vanguard, BlackRock, First Trust. These are not firms that want their products, their name trading at a discount.
So Saba is a hedge fund, we know that, and according to BlackRock, it's an activist hedge fund. That was, of course, there's a little bit of a dispute going on there. How exactly involved is CEFS when it comes to activist campaigns run by Saba?
Sure. So the ETF itself does not initiate activism. It is not an activist fund. It benefits from Saba being a large $5 billion asset manager. And, we have some funds that can employ leverage. So we actually own $6 billion of these closed-end funds. It may not be, closed-end fund market may not be as big as the ETF market, but it's 430 billion. There's more than 700 funds out there, and so there's a lot to buy. And so we can leverage, the engaging that we're doing with managers in some of our other products to benefit. They have overlapping positions as well, and it's not just Saba, right? There are other managers out there that want to collapse these discounts as well. They want to buy an asset that's worth $1 for 88 cents and then turn that 88 cents back into $1. And so there's a handful of smaller or maybe perhaps lesser known managers that do the same thing.
And when it comes to closed-end funds, I know some people go in there for the income, and some of these closed-end funds do use leverage. Can you explain that component? Not all of them do, but that's where the income can be much higher than, say, in a mutual fund or ETF.
Yep, so they have the ability to use leverage. Not all of them do, as you suggested. They can be up to a third in terms of a turn of leverage. And it is a good way for retail investors to achieve leverage. Now people want extra yield. They may want to have some additional exposure. And our ETF doesn't have a mandate to always be levered because it is actively managed. We can use that as a tool in our toolkit to take advantage when discounts are wide or markets are distressed. But at times we have utilized leverage, and that's another way that we've been able to outperform some of the other products out there, as Katie mentioned.
And so we only have about a minute left with you, but let's talk about asset classes here, because when you think about closed-end funds right now, you tend to think about munis because muni closed-end funds are trading at a big discount on a broad basis. But actually, your ETF, it's half equities, which I thought was interesting.
Yeah, so when we started the ETF, I know this is our 7-year anniversary, so 7 years ago, it was predominantly focused on fixed income assets and a lot of high yield. And over the years, the reality is we go to where the ball is. We go to where the opportunity is. And so more recently, the discounts have been in the equity space and the muni space. And so that's where we're going to target our efforts. It is an actively traded portfolio. And so we are going to rotate the portfolio based on where the largest discounts are, the best risk-adjusted return. So yes, right now, there is a sizable, I think, 45% allocation to equities. Munis is also very attractive. There's a great chart from Bank of America only a couple weeks old that shows just how persistent the stress in that market has been, even compared to moments like COVID or 2008. And of course, we're in an environment today where it is not a stressed market. S&P is hitting new highs. And so it's really interesting to have this pocket of the market that is still seeing that stress.
Well, Leah, unfortunately, we have to leave it there. Hope to have you back again soon. Really enjoyed this conversation. Our thanks, of course, to Leah Jordan of Saba Capital. And if you just can't get enough of ETFs, a reminder that you can listen to Eric and Joel Weber on Trillions. That's their podcast, of course, that covers the industry. But that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlett and Eric, and this is Bloomberg.